Welcome to the Edified Equity Podcast. My name is Dino, and here we focus on all the unique benefits associated with being a passive equity investor in an apartment syndication. You can learn more about and follow us on the web, iTunes, Stitcher, Facebook, YouTube, LinkedIn, Instagram, and our award-winning blog on Bigger Pockets. All associated links will be in the show notes. If you find this information helpful, please subscribe, like, comment, rate, and review. Today, episode number 53, we're going to be taking a deep dive into market analysis. Now, I do want to forewarn you, as a passive equity investor in a syndication, you are not responsible for doing all the due diligence on the market that we're going to be discussing today. However, your team is, and knowing what goes into and what reports go into the market analysis is going to help you analyze opportunities that are put in front of you by a team that you like, know, and trust. So without further ado, let's get started. Market analysis. So the first thing I want to cover is investing in your backyard, because this could very well be the best case scenario, but there are some pros and cons. So let's review a few. Number one, the pro is, you are going to be familiar with the area. You know what the market's doing because you live there. You're going to have a really good pulse on the economy as well as the population. Plus, chances are the building that you're looking at passively investing into is going to be within driving distance. It's also going to be much easier to build relationships with people that are local in your town. And I'm speaking of property management companies, for example, as well as the brokers that are going to bring you the deals. And property management companies as well can also bring deals to your team of operator. And this can actually be off-market deal flow for them. So local private equity investors like yourselves, you might also feel more comfortable just because it's tangible. You can touch it, see it, and feel it. It's right there in your backyard. Again, you can drive to it. And another opportunity for the operating team is not necessarily something that I recommend, because we hire out best-in-class third-party management to manage our properties, but you would have the opportunity possibly to self-manage and even create a property management company so that you can make sure your needs are being met as an apartment owner. Now, some of the cons are it can be expensive, possibly too expensive. And if you don't have any deals, well, you'll never get a deal done. Also, the returns could be too low for syndication, making it very difficult or virtually impossible for you as an equity partner to say yes to the opportunity at hand. So generally speaking, if it's too sexy, it could be too sexy for your investment. If this market is making national news, chances are everyone's already going there and it's too late. I have a saying that I like to use. You want to be in Austin before it becomes Austin. And same thing here. I'm based out of Denver, Colorado. You wanted to be in Denver about 7-8 years ago. Right now, it's very tough. Not saying it's impossible, but it is very tough. And we're looking at opportunities in the Southeast for that reason alone. So live where you love and invest where it makes sense. Selecting the right market. This is crucial because here's where you're going to be spending. Again, this is for your operating team, but they're going to spend hours, days, months. There's so much going into looking at opportunities. So you want to make sure you have the right market identified. Because this is, again, where they're going to be looking for and analyzing deals. They're going to be building out their team and operating in that area via the best-in-class third-party professional property management company that's in place. So have some market mandates. Now, this may or may not, this is, again, on the active side, but they don't necessarily have to like the market. But if they like it, that's a plus, because chances are someone on the operating team is going to be visiting and visiting possibly quite often, especially if there's a major reposition and they have to oversee construction and walk property pretty regularly. But something else to look for is, going back to, they don't have to like it, you don't have to like it, but overall, someone has to like it because you're going to be looking for growth, population growth, and as well as growth in the economy. And is there high yield? Do you have the opportunity to make money there in this investment? And is it scalable? You don't want to spend a lot of time analyzing a market if there's only one deal to be had. You have to know that there are going to be more opportunities so that when you dive deep into that market, you can scale it. As you let your property management company take on more opportunities that you're bringing their way, you can negotiate less of a fee. So if a property management company, for example, is charging you 7% to manage, once you give them 3, 4, 5 properties, perhaps you can take that down to 5%, 6%, maybe lower. And you can do the same thing with an asset manager. So one of the things that we really like to use is the Marcus and Millichap national as well as their regional apartment report. This provides great data and it ranks the top metro areas by vacancy. It lets you look at the rents, the sales, the cap rates in the area, what employment's doing, a supply and demand profile, and it also shows historical home ownership trends. All this is very important to know when you're analyzing a market. One of the tips I'm going to provide for someone, if you're active and you're looking for markets, because again, this comes from a passive point of view, you just need to know that this is what your team put into finding the market. But it's a good idea to identify 3 markets that you're going to be actively looking for opportunity in. So you want to look for, of course, employment and population trends. Look for yield. Again, can you make money? Look for growth in population, but a decline in home ownership. That tells you if people are coming here, but they're not buying homes, guess what? They're renters. It's no surprise because we are slowly but surely moving to a European model and having more renters nation. Several reasons for this. People enjoy the lifestyle that renting provides. They enjoy the amenities. They enjoy being free. You can sign leases for 6 months or a year and move around cross country, another state, whatever you want. Having that home kind of ties you down. Furthermore, millennials saw what happened in 7, 8, and 9 and witnessed their parents who may have been singing the song of owning a home is the American dream, but they saw the Great Recession and what happened to the single family world and possibly saw some of their parents go through a foreclosure, especially if there was a life event that caused a family to relocate and they simply couldn't swing paying 2 mortgages or renting and paying 1 mortgage. They were upside down and took a big loss. So the American dream of owning a home may not be there, and the trends in rent show us that it's not there for the millennials. So basically, look for the employment, the population trends, yield decline. We talked about that. Construction, how much is coming online? How well is it being absorbed? What about vacancy, rent? Is it in the path of progress? This is what you're looking for. Basically, you are following the numbers. Again, you don't have to like it. You don't have to want to live there. But overall, vast majority of people have to want to be going to that area in order for you to look at it as one of your top 3, maybe 5 markets to analyze and do deals in. We also look at the IRR viewpoint report. What this does is it plots major cities on the commercial real estate end, and it actually shows you a multifamily market cycle graph, which I'm going to show you in the next slide. But it gives you an overview of the economy, housing trends, the capital markets, interest trends, and employment. So let's take a look at the graph. So this is recent, depending on when you're listening to this, but 2009 IRR multifamily market cycle graph. And you can see there are 4 sections to the cycle. What we recommend is looking for something that's coming out of recession at the very tail end, or even possibly at the beginning of recovery, and through expansion, maybe even on the very tippy top of hyper supply, because this is just an idea of a cycle, and there's no telling how long a market is going to stay in a certain area of the cycle. And you can see below some of the differences. So for example, when you look at a place that's in recovery, anywhere in the recovery, and in this example, there's one, Houston, Texas, which is also, even it's in recovery and it's very competitive right now to find something in Houston. Decreasing vacancy, low new construction, moderate absorption, low to moderate employment growth, and a negative low rental rate growth. So they are the very beginning stages of recovery. Now, when they move into expansion, take a look at what's going to have happened there. Decreasing vacancy still in effect. So they'll have been experiencing decreasing vacancy rates for a while. That is good. Moderate to high new construction. Now we're seeing new product come online. High absorption. People are moving in. It's not a problem. To the demand and supply model there is still favorable. Moderate to high employment growth, that's a plus. And medium to high rental rate growth. Again, great opportunity to buy in the recovery and expansion. And of course, you want to be selling when you're in that hyper supply, and you want to be out of the deal when it's in the recession. Now, of course, having said all of that, if you buy right, you can weather the storm and ride out the cycle. Don't buy for appreciation. Force appreciation and leverage debt so that you can be around when the appreciation happens. However, buy for cash flow. So moving on, something else that we use to analyze is the Milken best performing cities. And what it does is identifies economic growth in successful regions. They take the top, like the largest 200 and the smallest 200 metro areas, and they analyze it. They basically look at job creation, wage gains, and some technological development metrics. They use all of this to evaluate growth of those markets. Something else you can do, and this just takes a little bit of elbow grease, it's very worth it, is go granular. Contact the economic development offices and the Chamber of Commerce. Ask them for their annual reports and what the market outlook is. Ask them what's been approved, what's coming online in this area. Why are people going to want to move here? Why am I going to see job growth? Why will I see population growth? Sometimes doing that, you can get details that are not going to be viewed on the national scale, and that can really give you an advantage because, again, real estate is local, so staying within that local phrase is go to the local news, research what's going on in that city. What's the local news talking about? Again, look for what's coming, what's approved, not what's hearsay and what we're hoping for, what we know is definitely going to happen. If you know about that before it becomes major news and it's a slam dunk, meaning it's going to happen, and you get in there, you are really going to be able to benefit from some appreciation over the next 3 to 5 years. So this is something you can ask for your team of operators. Is there anything that was unforeseen to just the greater population's eye that we know about that's going to help us later on down the road? Of course, you want to look at crime. A C area is fine, but a C minus to a D area, that's a tougher decision. Although the cap rate might be high, they're more difficult to manage, and you're going to have a lot higher expenses because of the turnover and more likely to have tenants do things like damage property. So it's very important to have a best-in-class property management company that knows how to manage property in that area. But something that you can do is use the Trulia heat map. Now, it won't necessarily work for an apartment complex. However, you can find a house, a residential home near your apartment. Punch in that address and then use the heat map to analyze what crime looks like. You can also call the police department. Ask to speak to a patrol officer that has been servicing that area for quite some time. And ask them, tell them what you're doing. Again, this is going to be on the operating side, but sometimes as a passive investor, if you have your reservations, you can do this and add it to your due diligence tool bag. Hey, what's going on in the area? You've been patrolling it for 7 years. What's it like at night? Is this an area we should be afraid of? I'm about to buy a $7 million apartment complex. Oh, by the way, here's the address. What do you know about that? Is it where all the trouble lives there? Or is it relatively safe and generally workforce housing? It's just honest families looking for a safe, affordable place to live. And of course, the property management company that you select should have really good insight on what's going on there. I remember once I was considering purchasing a property. I called up property management company that was highly recommended, and they said, I know exactly what property you're talking about. And in all honesty, we appreciate the business, but we're not willing to manage it. So that's the kind of outlook and information you want to get from heat maps, the police department, patrol officers, as well as your property management company. And then residential brokers. You can call residential brokers, even though you're buying an apartment, and ask them for statistics that are very important. For example, what are the days on market for the residential neighborhood around your apartment complex? For median to low priced homes, because that's going to show you demand. So you don't have to have a decline in home ownership in combination with a population growth. You can have a straight population growth as well as very low days on market for houses that could very well be for your tenant profile. If it's a competitive market to buy, chances are people are going to rent. Population is growing. People want to move there because there's job opportunity. Those are all really good signs. And for the most part, residential brokers are happy to help. And these are numbers they can rattle off at the top of their head. Oh, days on market currently are 28 days. That's a very good sign. However, they say days on market for this type of home is 90 days. Again, look at what's happening with home ownership in the area versus population growth. It might not be a bad sign, but it's definitely a good sign if the days on market are low. And then you can look at the U.S. Census Bureau interactive maps. They have so many different interactive maps, and it allows you you can narrow it down to the neighborhood. It's all color coded, and it can tell you what's going on median income wise. You can look at crime. There's so much to look at. What's home ownership been like? How's it currently trending? So it's a really good source to get very, very granular. So other ways to stay abreast, you can review these routinely. They don't cost, actually some will cost. So far, everything that I've spoken of doesn't cost a penny. But Globe Street is commercial real estate news. CoStar Advisor. Now, CoStar isn't complimentary, but CoStar Advisor is a complimentary weekly commercial real estate e-newsletter. You can customize it by market. Look at multihousingnews.com, the Multifamily Executive. Those one focuses on strictly multifamily, and Multihousing News focuses on commercial real estate news and market data. CBRE brokers, if they will be very willing to provide you with feedback, especially if they're helping your operators, and your operators probably have this data, but if they're helping secure the loan, they're going to do their own underwriting. Something you always need to remember is that no matter if you're getting your debt from Freddie Mac or Fannie Mae, someone is helping you with that loan. And Freddie Mac and Fannie Mae are by far, even as an equity partner, they are your number one partner. They're putting up 60 to 70, maybe 80% of the money to help take down this investment. So they're going to do their due diligence, and they will not give just any team or any market or any asset financing. You can also look at Paid, CoStar, and Reese. Really good market info, sales, rental comps. Your team of operators may have this, and you could ask them for it. But more importantly, you want to know that they've done their due diligence, and when they send you a deal deck with an opportunity to partner with them, most of this data should be just laid out there for you, spoon-fed. You should know whether or not they've done this type of research. And there's also CP Executive, and this has a regional commercial real estate news. So how do you start? So throwing a lot at you. Well, from a passive standpoint, you start with the deal. Because I always say, Richard Wilson says there's 3 levels of trust. Number 1, you have to like the asset class. So if you like apartments, you like multifamily, passive investments for the cash flow, the tax benefits, and the profit sharing, check. If you like the team of operators, you feel confident with their ability to win for everyone, check. Now, the third thing is the opportunity that they're going to serve you up. So as a passive investor, you start with the opportunity that they give you. But use the IRR report and look at what's at the tail end of recession or beginning recovery or even an expansion, possibly in the early stages of hyper. That's a good place to start. What areas do you like? As an active team, this is more important because they're going to be visiting. But again, you don't even have to like it. You just have to have other people like it and a large amount of other people liking it. Identify your top 3 markets and use all of the other reports and methods to drill down and help you make a decision. Then your team will build relationships. They're going to call commercial brokers. That is the number one way to find deals. They can find commercial brokers through LoopNet, Marcus and Millichap websites, CBRE, and Sphere Van Ness websites. Call them up, introduce, tell them what you're looking for, even plan, the active team now, I'm going to plan a trip out there to meet with them face-to-face and really build that relationship. Ask them, hey, what are C class and B class? What are they trading on actuals in the market? What's the cap rates? What's the price per door? That information is going to allow your team of operators to assess whether or not they're going to be able to syndicate and give you the returns that you need in order to say yes to an investment. Ask for property management referrals. They're going to be a key player, and they're really, really going to know the local market. Huge advantage. And then, of course, your active team are going to want to get on their buyers list so they can start seeing deal flow. They can get on that VIP list, start getting pocket listings that very few other operating teams see. Possibly sometimes your team will be the only one to take a look. That's true off-market pocket listing. So in summary, how do you put this all together? You want to go granular and keep it very local because ultimately the deals are located where you are going to find them. So if you're willing to be patient, risk not finding a deal, wait it out, and have your active team fight it out in a tougher market, go for it because it's possible. But if you really want to get into an investment and you're in a situation possibly like a large 1031 exchange, or you have some IRA money that you just rolled over, and until you find that right opportunity, it's sitting there, hedging inflation. So sometimes there's a little bit of an urgency. If that's your situation, be willing to learn about other markets. There is no reason with multifamily apartment investing to be geographically constrained. There's really just no reason, especially if you're a passive investor, because you're passive. You don't have to worry about flying cross country or flying 2 hours or 4 hours away. That's all on your team, and that's their responsibility. So here's just a little overview of the things that we used in today's presentation. All of this, of course, is in the presentation. If you're watching it on YouTube, which I highly recommend you do, if you're listening on the podcast, I want you to go back to the YouTube channel, Edified Equity YouTube channel, and watch it there because this is really more of a visual. Great to listen to, but very much a visual presentation. So I hope you found episode number 53, Market Analysis, helpful. And whether you're here for the education, entertainment, or if you or someone you know has a problem finding the right place to invest their money, please help them by sharing this information. I don't have anything to sell, but I am on a mission, and I will be delivering quality, consultative, educational content on a routine basis. Thanks for tuning in. Make it a great day. You certainly deserve it. This is Dino Pierce, CEO of Edified Equity, signing off. Goodbye.